couple of key trades. We had some exposure to healthcare REITs. We did really like that space, very defensive, exposure to GP surgeries and walk-in centres, essentially the landlords to them, and to the ultimate tenant is the NHS. Unfortunately, the valuations, had a spectacular year in 2019. Valuations became a concern. PHP was trading at a 44% premium to NAV. Assura was trading at a 53% premium to NAV. So for us as value managers, we took the profits and we reallocated it into LXI REIT, which is, again, a long lease, 20 years leases, but it's a bit more commercial risk in those ones. They build and manage properties for people like Travelodge, Bupa, Aldi, Lidl. So there's a little bit more risk in there, but we think the risk-reward profile is much better. Also, we continued in Q4 and Q1 to build our position in gold. We've been doing that for some time now. It's now reached around 6-7% in the portfolio, and that has served us very well in the recent volatile markets. We think most people see kind of seek security in the big brand named funds, but we don't see that. We prefer small boutique names with low AUMs. If a manager has billions under management, his transaction costs are higher. It takes much longer to trade in and out of stocks. The opportunity set is much smaller because they'll have to buy large cap and giant cap stocks. Whereas a manager with a small AUM and a reasonable capacity on his portfolio, then he can buy any stock anywhere, so his opportunity set is much higher. We also find that the active share and the tracking error is much higher on smaller funds because they're looking for the long term. They want small, concentrated portfolios with the best ideas. As soon as your AUM gets too big, you have to expand the portfolio and bring more stocks into it. So for us, small boutique managers, we think there's an extra added value to buying those. There's actually been a paper released this week from Cass Business School, which they did some analysis, and there's actually a premium comparing boutique managers to the large AUM managers. So I would recommend anyone read that paper as well, because it kind of provides some academic background to what we do. So markets are very volatile at the moment. So as we do this now, the coronavirus is kind of wreaking havoc on markets. This presents a huge amount of uncertainty, and nobody can predict how this is going to evolve. But we do know already that it's going to have serious repercussions to the supply chain and global economies. So if you look back at history, though, there's been smaller outbreaks similar to this. 11 of the past 12 outbreaks, the markets have recovered quite quickly within 6 months. So if you look back at history, then we find that these things shock markets, but markets recover quite quickly. So we're not going to panic. We're not going to sell things at low valuations. If anything, we're going to maybe top up if the market overreacts and some of our stocks that we hold are trading on even more compelling valuations, then we'll probably top up. We are long-term investors, so we won't be influenced too much by what's happening in the short term, and we'll hold things for the long term. Yeah, diversification is massive for us. As multi-asset investors, we want to diversify risk and we want to diversify the return drivers. So we have a number of kind of pots in the portfolio: UK equity, overseas equity, fixed income, and specialist assets. So each one of those pots will behave differently and will have different performance drivers. But then within each of those pots, there's different performance drivers. So UK equities invest across a number of different sectors and a number of different drivers. Overseas equities, we invest in emerging markets, Asia, potentially the US, Europe. Again, a huge spread of stocks and different drivers. Fixed income, we have some short duration assets. We also have an investment trust that invests in small issues. So again, this one is trying to generate some revenue off the liquidity premium. And finally, the specialist assets bucket, which is the most diversified of all, which has property, infrastructure, royalties, aircraft leasing, and some of them are wildly diversified. And overall, that creates one huge portfolio that has a number of different drivers and reduces risk across the portfolio. So prior to the viral outbreak, markets were quite expensive across the board, whether it's fixed income, whether it's equity markets. But we can't generalise a market as a whole. Within every market, there's pockets of value. But probably the two most attractive markets, specifically in the equity space, would be the UK, where we're exposed to domestic UK stocks. So they're suffering at the moment because of the Brexit uncertainty. So they're trading at very low valuations and very attractive to us as we all sit and wait out the kind of Brexit crisis. And as things resolve, those valuations should return to historic norms, and we'll do very well out of that. Also, Japanese equities. I know this has been said before over the past 20 years, but there is kind of structural changes going on in Japan. Legislation is making companies more shareholder aware and more shareholder friendly. Then to compound that, you've got activist funds. There's more and more activist funds sprouting out in Japan every day. And they're then buying shares in companies and encouraging the board to adopt more shareholder friendly practices. So they compound those two things with valuations in Japan that most stocks are trading, a lot of stocks are trading at valuations that are lower than historic norms. That mix of those two factors, we think, creates positive future returns and a good scope for positive future returns.